Let me now bring on board Anish Damania, Head of Institutional Equities with Emkay Global Financial Services. He joins us live from Mumbai. Anish, good morning. Thank you for joining us. Anish, Indian markets are up 28% this year. They are up 8% in last 1 month. So what exactly are you recommending your clients, and how should long-term investors now position their portfolios?
See, as has been the case at the start of the year or the mid of the year, we have been always trying to say that don't look at the index, look at specific stocks and how one should capitalize on how the stocks fundamentals are doing, and capitalize on their growth trends. So you saw a trend when companies like in the FMCG space, in the pharma space, and up to the half of the year, stocks in the IT space did very well, especially the mid-cap side, and a couple of stocks like HCL Tech and TCS. I think in terms of the story is similar. You be selective in terms of the stock picks which you have. So now probably the focus is shifting towards more towards cyclicals globally, as well as probably in India as a matter of fact. So I would say that given the valuations at which they have come out, some of the cyclicals are looking okay.
What to your mind is exactly driving JPA or JP Associates? Attractive valuations or hope that they will be able to monetize their cement business very soon?
I think it's, if you look at JPA, one of the key issues which people had in their minds is the amount of debt which they had on their books. And a large reason also for the debt on their books has been this new cement plant which is going to go on stream. Now from their point of view, what they are immediately doing is they are encashing on the valuations which the cement industry is today giving, and if they get those kind of valuations, then it's going to be a good deal. So they have set up something at a book value of let's say $100 per ton in terms of EV, and if they are able to sell at 180, I think that's what they are looking for. So if that happens, then you see a great positive in the stock, because a lot of that amount will go towards a reduction in the debt, which is what typically the market is looking at. Their existing cement businesses which are running are anyways doing well. So what will happen is the cash flow from the cement will be used to fund their other infrastructure projects. So this is what is driving in a way the stock. I think the market is positive on its momentum. So when they see such kind of incremental good news flow, then the market tends to react. Now obviously we are betting on the fact that, when I say this, we are betting on the fact that they are going to actually sell their cement unit, and it's going to, the deal is going to be consummated. So if that happens, then I think we should see somewhere around 115 or 120 kind of a price range for this stock.
Anish, what your views on IT, and does it seem like all the pain and the bad news now is in the price, or is there some more weakness in store for the IT names?
I think the thing to consider is whether some of the other stocks in large measure can they outperform the IT sector. And what we have started seeing is that the round of commentary from most of the guys is seemingly negative, that they are lowering their guidance both in the mid-cap space as well as in the large-cap space. So till the time you start seeing something positive, I think IT sector is going to remain sentimentally weak.
Anish, if I look at the global picture, even though global markets are also, oscillating between hope and despair, Indian markets are up 28% for the current calendar year. For 2013, do you think we could clock similar gains?
Look, once again, I don't know where the market's headed towards. Certainly, I'm not seeing a 29% earnings growth to sort of give me a confidence that, okay, even if the P's were to maintain at the current high levels, you can still see market doing that kind of numbers, those kind of numbers. So what I'm seeing is probably a maximum 10% kind of growth in terms of visibility, which I have for whatever companies we track. So if that is the case, then I'm not looking at the index in that sense, that where it will be. What we are targeting is that whether a few companies which we are recommending, whether they are going to do well or not in the coming quarters.
So let's keep the index aside, Anish, for a minute. Since you insist on individual stocks, give me 3 names where you're confident of a 20% plus appreciation for 2013.
One of the stocks which comes to my mind is Dr. Reddy's. In that, what we are seeing is that the fact that Ranbaxy has to an extent lost out on its Lipitor thing with the recent issues which they have had. Ranbaxy, Dr. Reddy's has started gaining ground on that front. So we are seeing more visibility coming on Dr. Reddy's from that account. So typically we are going to see the valuations of Dr. Reddy move up to the valuations of its other pharma peers. So there probably I could see about a 15 to 20% kind of relative outperformance of the stock versus the market. Second stock which comes to my mind may not be for FY13 but in the immediate future is DLF. There things are shaping up, things are going, things in terms of their new projects are taking shape. Last quarter when they announced their numbers, they really had a debt reduction. So the incrementally the news is going to be positive on DLF. So these are majorly the 2 stocks which we think are worth it. In the mid-cap space, I would say we are looking at Greaves Cotton now. The stock price is 75. It's trading at about 8 times with a 4% kind of dividend yield. The stock has a positive cash flow generation capability across its last 5 to 7 years, and we see with a little bit of an uptick in its business, we could see about a 50% appreciation in the stock price over the next 1 year.
And it's good chatting with you. Appreciate you taking the time out and joining us on the show.